Hey guys, Mike Wang here, back with another video. Now you might be thinking that the thumbnail is clickbait, but it's actually not. Hear me out. Today, I'm going to be talking about the hottest equity in the market. These are absolute gold mines if you can do your research. I'll be talking about special purpose acquisition companies, or SPACs, in this video, what they are, and how to find the right ones to invest. I know it sounds complex, but I'll dumb it down and make it easy for even beginners to digest as well. If you can stick around until the end of this video, I guarantee you'll have learned something new and you'll be able to apply what I talk about in the video to your own investments as well. If you're new to the channel, please make sure to subscribe for more videos. As I said in the intro, SPAC stands for Special Purpose Acquisition Company. They're also called blank check companies or shell companies. But what is this special purpose that they're talking about? Their purpose is to acquire an existing company so that it's available for trades and investments in the stock market. They need to acquire a company within a given time frame between 18 to 24 months, sometimes 36 months depending on the conditions. Normally, companies go public through a process called initial public offering or an IPO. There's another method called direct listing, which is the method that Spotify and Slack use to go public, but for the sake of simplicity, we'll just look at a comparison of IPOs and SPACs. In terms of time period, SPACs can help companies go public much faster than if they were to go public through an IPO. The process is also much simpler and has less requirements, and it also costs less to go public through a SPAC. But the company's valuation is discounted when they get listed through a SPAC. For instance, if a company that has an enterprise value of $100 billion were to do an IPO, they'd be valued as a $100 billion company. Whereas if they get listed through a SPAC, they'd be discounted as an $80 billion company. So who makes these SPACs? Where do you get the money to acquire another company? That's the first logical question to ask. Normally, people with a reputation in the market make these SPACs. For instance, Bill Ackman, who's the CEO of Pershing Square Capital, is an extremely well-known investor. He has a lot of people that want to bet their money on him. So people like Bill Ackman are the ones who gather investors up and create a SPAC. When a SPAC is created and goes through an IPO, the shares are owned by three entities: the founder, individuals, and PIPE, which stands for Private Investment in Public Equity. The private stake refers to the shares that the founders or the creators of the SPAC get. The public stake refers to the shares that the individuals buy when the SPAC gets listed. PIPE refers to the investors who lend money to the SPAC so that they can acquire a company. So for instance, let's say that a SPAC is trying to acquire a $10 billion company, but they only have $5 billion in their trust. A PIPE can hop in and lend the remaining $5 billion to the SPAC, and in return, they get their shares of the acquiring company for a cheap price. So one SPAC unit consists of one share and the warrant that comes with the share. The warrant is essentially the right to purchase the SPAC share at a designated price later in the future. It essentially acts as an incentive for the SPAC investors who take on risk. But you can use the warrant only within a designated time period, which is usually divided into two conditions: either 30 days after the new company's IPO or 365 days after the SPAC IPO. I'll talk about this more in depth later in this video, so if you don't fully understand it yet, that's fine. The money for the SPAC is deposited in a trust, and the funds cannot be used for any other purposes than acquiring a company or refunding the investment seeds back to the investors in case an acquisition does not happen. So once the SPAC is listed, it's time for people to search for companies to acquire and negotiate. Once everything is prepared, they now move on to searching innovative firms, normally between a time frame of 18 to 24 months, sometimes a little longer depending on the conditions. The business that they acquire needs to be at least 80% of the value of the trust account. So for instance, if the trust account has $10 billion, the company that the SPAC acquires needs to be at least around $8 billion in fair market value. Once the negotiation is done, the acquisition is announced, they go through a process of getting permission from the SPAC shareholders. If the SPAC shareholders agree to the acquisition, they get shares of the new company equivalent to the shares of the SPAC they hold at a 1-to-1 ratio. If they were to disagree, they can simply cash out their stake. Once this is all done, the market decides whether you should make a lot of money or not. Let's take a look at an example to see how this actually works in real life. Let's take a look at this article. It says that a SPAC sponsored by Bill Ackman's Pershing Square Capital made its debut to the New York Stock Exchange with the largest blank check IPO. The offering includes 200 million units at $20 each, railing $4 billion in proceeds. Each unit consists of one common share and 1/9 of a warrant that's exercisable at $23. So the ticker of the SPAC is PSTH, and the company that they're acquiring hasn't been announced yet. So let's just say that they're buying a company called Mike's Burgers, which will be listed under the ticker MIKE. So you're an investor and you buy 9 shares of PSTH at $20 as soon as it gets listed. You now have 9 shares and a warrant that you can use, since one unit of the stock includes 1/9 of a warrant. So you have 9 shares and a right to purchase one more share at $23. Let's say Mike's Burgers got listed on the New York Stock Exchange and the stock goes wild because the burgers taste great. After the IPO, the stock trades at $50 a share. You, as an investor, think that the stock prices could go higher for whatever reason. So you decide to wait 3 more weeks so that you can use your warrant. 3 weeks later, the stock soars a bit more and trades at $60 a share. You now have 9 shares that you bought at $20 and you exercise the right to purchase one more share at $23. You then sell all 10 shares at market value. So when you sell all your shares for $600, you're left with an initial investment of $203 and $397 in profits. So in a trade like this, you would have doubled your investment easily. Before we move on, please make sure to subscribe to my channel before you forget, and also smash that like button for the YouTube algorithm as well. Now, it sounds like sunshine and rainbows, but let's take a look at the risks involved in buying SPACs. First of all, the risks involved in pipe selling their stake. It's not like these entities have a lockup period. They can sell their shares as long as they have permission granted from the SEC, so there's risk involved in that. For instance, Nikola's stock prices plummeted after its pipe sold all their stake. Secondly, you're investing in a paper company and you don't know which company they'll acquire. Normally, SPACs are run by veteran investors who know what they're doing, but there's absolutely no guarantee that the company it acquires will be a good one. For instance, there were rumors about how Bill Ackman's SPAC would be acquiring Airbnb, but as you guys know, it turned out to be fake. So as an investor who's not an insider, it's hard to invest in a paper company without knowing what will happen to the SPAC company. So we obviously want to minimize risk and maximize our returns. And to do that, it's important to choose the right SPACs to get into. I'll be providing my own strategy on finding the right SPACs, and I call this the 2N strategy. The key of this strategy is a combination of narrative and numbers. This is how I select stocks to invest in as well, but the approach to SPACs is slightly different. What do I mean by narrative? I mean that the SPAC or the company that they're acquiring needs to have a good story. They need to have a good leader for the SPAC. They need to acquire a company in a prominent field and a management team with expertise in the field. So here's some things I'd look for. First of all, I would want to see a figure who's already acknowledged and successful. Of course, it'd be better if they have a successful SPAC deal experience. Bill Ackman is a good example of someone I'd have my money on. I would also look at the backgrounds of the members of the management team. Look into what their expertise is, their work experience, professional backgrounds, and any noteworthy achievements. This type of information is normally all available on the SPAC's website, but you can also look them up on LinkedIn. Also, look into the institutions that are involved. If big names like BlackRock and CVC are taking part and they hold SPAC shares, that's good news. So you want to make sure that acknowledged institutions are behind the project. Last but not least, it's important to look into the industry that the SPAC has eyes on. You want to take part in a prominent industry, and obviously the trend for now is tech. Electric vehicle SPACs have also shown some crazy performances recently, but make sure you invest in a SPAC that operates in a field that you're familiar with and has high growth potential. Now, let's take a look at what I mean by numbers. Before we can talk about numbers, we first need to understand how we can capitalize on SPAC opportunities. The best thing about SPACs is that you can minimize your losses or even trade risk-free if you're lucky enough. The offering price of a SPAC stock varies depending on the company, but normally it's around $10. And the best thing about investing in SPACs is that there is a price floor. If you don't know what a price floor is, here's a quick Econ 101 session. A price floor quite literally means that the price cannot go below a certain point. Minimum wage is a good example of a price floor. You can't receive anything less than the legally set minimum wage. Same thing with SPACs. It's not that prices are legally prevented from trading below the initial IPO price, but there's no reason for it to be traded anything below than its offering price. Because in the unlikely case that an acquisition does not take place, everyone gets a refund anyways. So basically, given that you enter at the offered price, there's nothing to lose and everything to gain. This is what makes SPACs special. So you might ask, how much is there to gain? The answer is at least as much as its net asset value. In case you don't know, the net asset value is calculated by subtracting all liabilities from the asset a company has and dividing it up by the total number of common shares. If you actually do your due diligence and calculate the net asset value of the SPAC you're investing in, you'll realize that the net asset value normally ranges around $10.10 to $10.25 right off the bat. This means that you have a 1 to 2.5% default return before even taking into account the warrant value, which is substantial, and the upside opportunity as well. So going back to what I mean by numbers is, you either want to find a SPAC that is traded at around its offered price or below its offered price. A SPAC that is already trading at 3 times its offered price probably won't get you the best returns. You want to find a SPAC that's cheap. Also, I can't stress this enough, but make sure you check all the numbers. Check the trust value, the SPAC's market cap, and their net asset value. You want to make sure you get into the companies with a high trust value and a net asset value that's not too far from its market price. The whole point of getting into SPACs is to reach untapped parts of the market before other people realize there's money to be made. So there you have it, guys. That was a full rundown on what SPACs are and how to find the right ones. I'll be uploading more of my personal analyses on some SPACs I have my eyes on, so make sure to check out my website as well. If you want to learn and discuss more about SPAC investments or investments in trading in general, feel free to join the community I run as well. You can access the community through my website. If you have any other questions or suggestions, feel free to leave a comment below. If you found this helpful, don't forget to like this video, subscribe for more content, and I'll see you guys in the next video.